So we're going to transition here, and we're going to transition from state sales taxes to federal income taxes. Specifically, something I see entrepreneurs get wrong all the time. I was just talking to an entrepreneur 2 weeks ago looking to buy real estate, and was telling me all the tax benefits that he was going to get. And I hated breaking it to him, but he was going to get no tax benefits from it, because people just hear, oh, real estate tax benefits, but there's a lot more that goes into it. So every entrepreneur I meet thinks that they understand these real estate tax strategies. They buy a building, throw in an entity, take some depreciation, and oftentimes they're leaving a lot of money on the table because they don't understand Section 469 and active versus passive when it comes to real estate. So, Jim, I know this is a space, Section 469, fond to your heart. Break down active versus passive and what this means when it comes to real estate investments.
Yeah, well, as you said, entrepreneurs think that, oh, you know what, I get depreciation from real estate. So if I do a cost segregation study, I get a bunch of depreciation, then it offsets my income. Depends what kind of income you have. So if you have active income from a business, and let's just assume because I know we're going to cover it in a second about, what you can do being a real estate professional, but let's say you have an active business unrelated to real estate, you buy a building to run your business out of, you cost seg that, and you get this huge depreciation write-off. And you think, man, that's going to wipe out a bunch of taxes. And to your point, it doesn't wipe out your taxes, because generally depreciation from real estate offsets passive income, not active income. And so it doesn't offset the active income from your business. So that's a big gotcha there. And there's, again, some ways around this. And one thing is the Section 469, where you can do this thing called grouping and group together the business and the real estate depreciation in a way. It's a one-time election, has to happen when you buy the building, and then you can actually unlock that depreciation to create massive tax benefits. So anything I missed there that you want to add to that?
No, yeah, we're going to talk through the 469-4 election, which is exactly what you talked about, and that's what a lot of the entrepreneurs who are tax efficient are doing. But again, going back to 1986, when Reagan rewrote the tax code, it essentially said, by definition, if you are investing in real estate, that is passive unless you can overcome a certain level of threshold to make it active. And that's what's called the qualified real estate professional designation or status underneath 469C7B. So in order to overcome real estate being passive, you need to really do three different things. First thing is you need to spend at least 750 hours of services in a real estate trader business. The second thing is more than 50% or half of your time must be in a real estate trader business. So this prevents the people who are working full-time jobs from then spending another 750 hours, as they allege, on top of it, which means they're working 100 hours a week. And then the last thing is you need to materially participate in the rental activities. So that's generally 100 hours and more than anybody else, or 500 more hours. Now, you can aggregate together material participation with the 469-9 election to group multiple activities together. So for example, if you own 10 different properties, you can't spend 500 hours on each property. You aggregate those together, and then it's the basket. So if you pass these three tests, then what happens is all of that real estate activity flips from passive to active. But the thing entrepreneurs don't understand is that it defaults to passive. So unless you beat this hurdle, which is not easy, all of those losses are passive losses.
And we've seen sometimes where an entrepreneur can have the spouse that qualifies. What I see most often, though, is that they claim this, but they don't have the documentation or the proof that they actually qualify. And boy, that's a ripe target for the IRS if you get audited.
Yep, you want an hour tracking log. That is something that we definitely make sure that we help our clients put together there. So exception number 2 here. So like you mentioned, the 469-4 grouping election. And so this is really where, to your point, if you have an operating business and you have real estate and you're running your operating business out of your real estate, you can group these two things together. And then this allows you to take the depreciation or losses from the rental property or from the actual physical property and use that to offset and really aggregate together and offset income from your active trader business. So in order to...
Otherwise it gets trapped, and it could be trapped in there for years and years and years.
Yep. And to your point, they need to be aggregated together as an appropriate economic unit, and they can be grouped if the rental activity is insubstantial, if the trader business activity is insubstantial in relation to the rental activity, or each owner of the trader business has the same proportionate ownership interest. And that's the threshold that most entrepreneurs are going to hit. So again, you own 100% of your business, you own 100% of this real estate, your business is leasing the real estate. Now you can aggregate these two things together. And so then what you're going to want to do is write, this is actually like a written statement. It's not a check the box, but it's a written statement that the CPA should make, on your tax return, letting the IRS know that you're aggregating these two together and referencing the section of the code.
Yeah, it's one we've seen missed a lot. And when you can get it, boy, it's powerful.
Yep, it's powerful. And it is generally a binding election, so you can't undo it unless there's a material change, which is difficult burden. So that being said, one other issue we see when it comes to owning real estate and having an operating business is that some people will buy the real estate in their S corporation, and that is a huge no-no. So when you're buying real estate, you want it in a separate entity. That helps from a liability perspective, and you always want it in an LLC. You never want to make the S election. There's really three main reasons. The first is that you don't get debt basis in an S corporation. And so you're only allowed to take losses up to your basis, which is really like how much money you've put into that business. Now, in an S corporation, you don't get basis for taking on debt, but in a LLC, you do get basis for taking on debt. So that allows you essentially to write off more losses if you're not in an S corporation because you have more basis. Second thing is you have no flexibility moving assets out of an S corporation. So when you move any type of appreciated asset out of an S corporation, it's a deemed distribution, and that triggers capital gain taxes. So even if I want to move it out of my S corporation to me as an individual, and I am the same, I own the S corp, it doesn't matter. When an appreciated asset leaves the S corporation, you pay capital gain taxes on the appreciated
And we've seen
amount.
a lot of problems with that because it was incorrectly put in an S corp, but to get it out of the S corp is a triggering event for taxes.
Yep, exactly. So it's hard to get that cleaned up too.
Right.
And then the last thing too is when you do a transaction, generally the buyer, private equity especially, is not going to want the real estate. And so if it's all tucked underneath one entity, it's a little bit harder to unwind that. Whereas if it's an operating business and then it's the real estate, then oftentimes what happens is they'll buy the operating business and you can lock in a long-term lease with the new buyer, and now you actually have a lot of passive cash flow. So again, always hold that real estate in a separate LLC, but never make the S election in that LLC.
Good advice.
All right, and then this with the 100% bonus depreciation, right? And you mentioned cost segs. Just to reiterate, cost segs allows an engineer to go in and break down the building, which a commercial building is normally depreciated over 39 years. But an engineer comes in and says, well, the cabinets, the flooring, the HVAC, some of these are improvements. Some of these are going to be depreciated over 5 years or 10 years or 15 years. Well, anything with a 20-year useful life or less can get bonus depreciated after the one big beautiful bill. So as a rough rule of thumb, around 30% of the value of the building, which isn't necessarily fair market value because you have land in that equation too, but around maybe 30% of the building can generally, it depends on the type of building, be cost segged or written off day one. And so again, that's cost seg combined with bonus depreciation. That's how we're stacking strategies to accelerate some of the deductions here.
Yeah, it's a powerful thing that the one big beautiful bill put back into play.